Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Digital Turbine.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick note before we really get going, you can find a special 14-day trial link for StockOracle down in the description below.
Right, and just to be super clear, right up front, StockOracle is an AI-aided stock research platform. So, it is not financial advice, and it's definitely not a trading signal service or some kind of real-time market data feed.
Exactly. And that link is an affiliate link, which basically means the channel may earn a commission at no extra cost to you. But remember, AI insights and valuation estimates can sometimes be incomplete or just flat out wrong, so you always need to verify important facts for yourself.
Absolutely. Do your own homework.
Always. So let's jump right into the wealth building context for today's stock. Digital Turbine, ticker APPPS. I want you to picture a heartbeat on a hospital monitor, just flatlining for months.
Oh man, it really was.
Yeah, I mean, the stock was sitting at this absolutely dismal 52-week low of just $2.74 a share.
Like the market had essentially just written it off completely.
Totally. They left it for dead. And then out of nowhere, beep, you get this violent 38% single-day jolt, and suddenly it's rocketing past $13 a share.
Which is, that's just the absolute definition of a massive head-turning surge.
Right.
And it immediately forces this really critical question. Is this patient actually cured? Or did they just get, this massive temporary dose of adrenaline that's going to wear off by tomorrow morning?
And that is exactly what we need to figure out today. Because if you're listening to this and you're feeling, a little fatigued by the market's endless obsession with just the massive tech giants, this is such a breath of fresh air.
Oh, for sure. Finding a mid-cap turnaround story like this, especially one that's claiming to be fueled by AI, it's this incredibly rare opportunity.
Yeah, to see how market momentum and actual fundamental business shifts collide in real time.
It's a phenomenal case study because, look, it is really easy for a tiny mid-cap stock to move on whispers or just random rumors.
Right.
But it's an entirely different beast when a company tries to completely rewrite its narrative using cold, hard operational data.
Yeah, the fundamentals.
Exactly.
Yeah.
Analyzing these smaller pivots, that's where you often find the most crucial lessons about, measuring risk against potential reward.
So let's talk about the sheer violence of this technical price action, because the scale of this move is honestly jarring.
It really is.
We're talking about a stock that closed at $13.17, which is a 38.49% single-day pop.
And it even touched $14.10 intraday.
Right. And it didn't just slowly climb there throughout the afternoon. It gapped up dramatically right at the open.
Yeah.
It opened at $11.95 after closing the previous session at just $9.51.
And that gap up is, mechanically, it's just fascinating to watch.
How so?
Well, when a stock opens nearly $2.50 higher than where it closed just a few hours prior, that tells you a very specific story about institutional desperation.
Desperation to buy, you mean?
Exactly. It means that before the regular market even officially opened, the institutional demand to buy those shares just completely overwhelmed the available supply.
Wow.
Yeah, the sentiment swung from this severe, lingering pessimism to just euphoric optimism almost overnight. And, this isn't an isolated spike either.
No, it's not.
Over a 13-week period, Digital Turbine is up 158.4%.
That's insane.
Year to date, it's up over 90%.
Okay, but I have to pump the brakes here for a second because those triple-digit return numbers, they kind of mask a pretty terrifying underlying metric.
You're talking about the beta.
I am talking about the beta. The data clearly flags that this stock has a beta of 3.0.
Yeah, that is high.
For you listening, a beta of 3.0 means this stock is essentially a high-performance sports car with absolutely zero traction control.
That's a great way to put it.
It is mathematically designed to move roughly 3 times as violently as the broader market.
Right.
So if the S&P 500 goes up 1%, Digital Turbine tends to go up 3%.
Which is great on a green day.
Sure. But if the broader market simply sneezes and drops 1%, this stock plunges 3%. With that kind of built-in structural volatility, is this stock just too dangerous for a regular retail portfolio.
Well, it undeniably amplifies both the upside and the downside risk. So it is absolutely not for the faint of heart.
Right.
And you definitely cannot treat it as some kind of defensive play. The volatility here is a feature of this specific asset. It's not a bug.
So if you want stability, run away.
Exactly. If you're an investor prioritizing capital preservation, a beta of 3.0 is a glaring warning sign to just stay away.
But what if you want growth?
Well, that's the flip side.
Uh.
If you're actively looking for alpha, for market-beating returns, that specific volatility is the exact mechanism that allows a 38% single-day surge to happen in the first place.
Ah, okay.
The key isn't avoiding the sports car, it's knowing how to drive it, which usually means managing your position sizing very, very carefully. So a sudden crash doesn't just completely wipe you out.
That makes total sense. So if the stock is a sports car with no traction control, somebody clearly just slammed a brick on the gas pedal.
Oh, absolutely.
And that fuel, the catalyst for all of this, was the Q1 fiscal year 2027 earnings report. Because, let's be real, a stock doesn't gap up like this on a random Tuesday without hard numbers to back it up.
No, the numbers in that report were the undeniable catalyst here. They reported $166 million in quarterly revenue.
Which is a 27% year-over-year increase, right?
Yes. And more importantly, it comfortably cleared the Wall Street consensus estimate, which was sitting at $150 million.
Okay, but beating consensus is obviously a great headline. We need to look under the hood to see if they actually built a better engine or if they, just slashed a bunch of costs to make the spreadsheet look pretty for a quarter.
Right, the quality of the earnings.
Exactly. So when you break down how this company actually makes its money, they have two core segments.
Yep.
First is their on-device solutions, which generated $110 million in net revenue. That's a solid 15% year-over-year increase. But they aren't exactly a household name, so what does on-device solutions actually mean in plain English?
Think of it as owning a digital toll booth.
Okay, a toll booth.
Yeah, Digital Turbine's legacy business relies on OEM or original equipment manufacturer partnerships.
But people who make the phones.
Exactly. They literally negotiate with massive telecom companies like Verizon or hardware giants like Samsung to embed their app recommendation technology directly into Android devices.
Well, before the consumer even buys the phone.
Right. When you turn on a brand new phone for the very first time and you see a folder of suggested apps sitting right there on the home screen,
Yeah.
that is very often Digital Turbine at work.
Wow, okay. Well, owning the toll booth on a new smartphone sounds like a literal license to print money. But the data mentions it's actually a really difficult model to scale. Why is it such a grind?
Because you have to fight tooth and nail for a tiny, tiny piece of digital real estate.
On the screen.
You are negotiating door-to-door with absolute behemoths. Those contracts take years to secure, the terms can be completely brutal, and if a major carrier just decides, hey, we want a bigger cut of the ad revenue.
Your margins just get totally squeezed.
Exactly. It's highly lucrative once the toll booth is actually built, but building new ones is incredibly slow and labor-intensive.
Okay, so the toll booth is basically paying the bills and keeping the lights on. But the real story, the catalyst that actually caused this stock to just explode is their second business line.
The app growth platform.
Yes, the app growth platform. That segment brought in $56.6 million, which represents a staggering 56% growth rate year over year.
It is massive.
And management is loudly attributing this to their new AI tools and performance optimization. But what is this platform actually doing? Is it just like a digital billboard?
Oh, it is much, much smarter than a billboard. This is their entry into programmatic mobile advertising.
Okay.
Instead of just throwing ads at a wall and hoping a consumer clicks, this AI-driven platform is analyzing real-time user behavior to serve highly targeted app install recommendations.
So it's predicting what I actually want to download.
Exactly. It predicts which specific user is most likely to not only download an app, but actually open it and spend real money inside it.
Ah, the holy grail for advertisers.
Right. So advertisers are more than happy to pay a massive premium to Digital Turbine because the AI delivers much higher conversion rates than traditional blanket advertising.
See, I look at a 56% growth rate and I just naturally get skeptical.
That's fair. Like, is this massive jump actually proof that their bet on AI is structurally superior? Or are mobile advertisers just temporarily flush with cash this quarter, creating this, cyclical bump that's just going to fade out?
Well, while the broader ad market definitely has cycles, 56% growth significantly outpaces the general industry trend right now.
Really?
Yeah, which validates the structural argument. Honestly, it is the single most important metric we're talking about today.
Why is it that important?
Because it signals a successful diversification. They are proving they can monetize the broader app ecosystem without having to rely entirely on those grueling, slow-moving OEM contracts we just talked about.
Toll booths.
Right. When a management team tells Wall Street that their new, higher-margin, AI-driven segment is growing at nearly 60%, and then they raise full-year guidance to back it up.
Yeah, they targeted 650 to 670 million in revenue, right? Exactly, and up to 155 million in adjusted EBITDA. When they do that, Wall Street is essentially forced to aggressively reprice the stock upward.
Okay, so that is the polished, shiny bull case, accelerating top-line growth, AI integration that's actually bearing fruit, and raised guidance. It sounds bulletproof.
It does sound great.
But there are always hidden traps. And when we look at the bear case, there are some serious financial risks lurking just beneath the surface here.
Absolutely. The numbers require a much closer look, especially when you transition from top-line revenue down to actual profitability.
Let's start right there, because there's this weird friction between their current quarter and their trailing performance.
Yeah, the EPS.
Right. On a quarterly basis, things look perfectly fine. Yeah. They reported a Q1 earnings per share, or EPS, of 19 cents.
Which beat the expected 14 cents.
Exactly. But when you zoom out and look at the trailing 12-month EPS, it flips. It flips to negative 35 cents.
Yeah.
And their net margin over that same trailing 12-month period is a negative 6.68%, even though they boast a really healthy gross margin of around 48%.
Yeah.
So how can a company have such a blowout quarter but still be bleeding money over the course of the whole year?
This really comes down to the critical difference between adjusted EBITDA and GAAP net income.
Okay, unpack that for us.
So when management talks about their success, they heavily promote their adjusted EBITDA, which is a non-GAAP metric.
And non-GAAP basically means they make their own rules.
Well, essentially, non-GAAP means the company is allowed to strip out certain expenses to show you what they believe is their core operational profitability.
So they exclude the bad stuff.
Exactly. They exclude things like the amortization of past acquisitions, restructuring costs, or, heavy stock-based compensation given to their employees.
It's like doing my household budget but leaving out my mortgage and my car payment to make it look like I'm saving a ton of cash.
That is a perfect analogy. They are taking the ugliest expenses off the spreadsheet to make the current quarter look pretty.
But GAAP accounting doesn't let them do that.
No, GAAP, which stands for Generally Accepted Accounting Principles, forces them to include all of those painful realities.
Hence the negative trailing earnings.
Right. That trailing negative 35-cent EPS tells us that on a strict, fully loaded accounting basis, the company is still digesting heavy prior periods of losses and expenses.
Got it.
Yes, the quarterly trajectory is certainly improving, but they have not yet demonstrated that they can sustain full-year GAAP-verified profitability.
And the market is just ignoring that right now.
The market is currently rewarding them for their top-line revenue growth and their adjusted numbers. But, if that AI-driven revenue growth ever decelerates, the lack of a true positive GAAP earnings floor means this stock could plummet just as violently as it rose.
Man, that makes the structural risk we touched on even more dangerous. Because even with the app growth platform exploding, the lion's share of their revenue,
The 110 million.
right, out of the 166 million total, it still comes from those legacy OEM toll booths.
Yeah.
If they lose just one major phone manufacturer or a contract gets renegotiated unfavorably, that is a massive blow to the company's foundation.
It's a severe concentration risk. When the majority of your cash flow is tied to the whims of a handful of telecom gatekeepers, you just do not have full control over your own destiny.
Right.
That vulnerability is structurally embedded in digital Turbine, and a momentum-driven market that's just swept up in AI hype, well, they'll happily ignore that risk right up until the exact moment it becomes a reality.
And that brings me to the red flag that stood out to me more than any other metric we've looked at today. The insider trading behavior.
Ah, yes, the sentiment data.
Over the trailing 90 days, company insiders have made exactly 0 open market buys. 0.
Not at all.
But they have executed 4 sales, dumping a combined 27,673 shares. The data notes the insider MSPR is negative 100. let's translate that for the listeners. What exactly is an insider MSPR?
So MSPR stands for Management Sentiment Percentile Rank.
Okay.
It is a metric used to score how bullish or bearish a company's internal executives are, based solely on their own personal buying and selling of the company's stock.
So a score of -100.
Means the sentiment is as mathematically bearish as it can possibly get over that specific time frame.
Wow.
Literal every single insider transaction recorded was a sell.
See, I have to aggressively question this. You have management on the earnings call touting this massive AI-driven turnaround, raising guidance, cheering the 56% growth.
Yeah.
If this turnaround is the real deal and the stock is genuinely a bargain, why are the executives inside the spaceship quietly selling their tickets?
It is the ultimate cautionary signal, honestly, because actions with personal capital always speak louder than earnings transcripts.
Always.
When insiders refuse to participate in the rally on the buy side, it strongly suggests a lack of absolute conviction in the stock's current valuation.
Right.
However, we do have to maintain some perspective on the sheer scale of the selling here.
What do you mean?
Well, Digital Turbine has a market cap of approximately $1.15 billion.
Okay.
The total shares sold by insiders, about 27,000, is a relatively modest amount of equity in the grand scheme of things.
So it might just be executives selling to pay their tax bills or maybe buying a new house rather than a signal that the whole company is doomed.
Precisely. Executives receive a lot of their compensation in stock options, and routine scheduled selling for personal liquidity is totally normal.
Sure, that makes sense.
But you are entirely correct to highlight the directional warning here. The sheer absence of any insider buys during a period where the stock was sitting at a multi-year low of $2.74.
Yeah, that is the part that stings.
It tells a story. The people who know the company's books better than anyone else in the world didn't view it as a screaming bargain.
Right.
It is a tangible risk that the retail market, which is currently just caught up in the momentum, is likely not pricing in.
So we have a really fascinating collision of data here. We've got explosive AI revenue growth and raised guidance, fighting against negative trailing gap earnings, heavy concentration risk, and completely uninspired insiders.
It's a mess.
So how do the professionals on Wall Street actually grade a complicated setup like this?
Well, the external market perception right now is complete battleground of ideas. Wall Street is totally divided on what this company is actually worth.
Because the public news sentiment is overwhelmingly bullish, right? The headlines are universally declaring this a smash turnaround.
Yes.
But when you look at the actual analyst ratings, there is a wild, almost comical disconnect.
Oh, it's huge.
Benchmark maintained a buy rating and actively raised their price target from $15 up to $16.
Right.
But then you have BofA Securities, Bank of America. They also upgraded this stock to a buy, but their price target is just $7.50.
Yeah, less than half.
Which is baffling, considering the stock is currently trading well over $13. How can two major financial institutions look at the exact same Q1 data, the exact same AI growth, and come up with price targets that are light years apart?
This discrepancy provides a brilliant window into the psychology of how different Wall Street firms actually model value.
Okay.
They aren't looking at the data differently. They are looking through entirely different philosophical lenses.
Explain that.
When Benchmark slaps the $16 target on the stock, they are looking through a pure growth investing lens.
Right.
They are heavily weighting the forward-looking metrics. They see that 56% growth in the app growth platform. They trust the raised guidance for the adjusted EBITDA.
And they just project that outward.
Exactly. They're modeling a world where Digital Turbine's AI tools continue to rapidly capture market share. They are more than willing to forgive current accounting losses because they are paying a premium for future dominance.
Okay, so what lens is Bank of America looking through to arrive at 750?
BofA is forced to look through a value investing lens, which is a much more conservative, skeptical framework.
Ah, so they care about the gap earnings.
Heavily. They are anchored to the negative trailing profitability we just discussed.
Right.
The data points out that the stock trades at a price-to-sales ratio of 2.03 and a price-to-book ratio of nearly 6.
Okay.
But because the trailing gap earnings are negative, traditional valuation metrics like the price-to-earnings ratio, the PE ratio, they're virtually non-existent.
You can't have a PE ratio without the E.
Exactly. So BofA is essentially saying, look, yes, the top-line trajectory is improving, which is why we upgraded you to a buy.
Right.
But until you can actually prove you can generate sustained, JAP-verified net income, we refuse to assign a premium multiple to your stock.
So BOFA is demanding proof of actual profits, while Benchmark is basically just buying the AI growth story.
Pretty much.
I mean, it's possible BOFA's target was formulated just before the full extent of this latest earnings catalyst was digested by their models, but regardless, it perfectly highlights that there is zero consensus on this stock's true intrinsic value.
Exactly, which means the upcoming fundamental catalysts are going to be hypercritical for settling the debate between those two camps.
What are the next catalysts we need to watch?
Well, all eyes should definitely be on the Q2 fiscal 2027 earnings, which are expected to drop in late October or early November.
Okay.
We also need to watch for upward estimate revisions from analysts over the coming weeks as they finish digesting the new management guidance.
Right.
But crucially, the market needs to see if Digital Turbine can finally transition to positive GAAP profitability on a trailing basis over the next couple of quarters.
Transitioning to positive GAAP earnings seems like the ultimate holy grail for them right now.
Oh, it changes the entire institutional profile of the stock. Well, if they can flip that trailing EPS from negative 35 cents to a positive number, it instantly opens the stock up to an entirely new class of massive institutional investors.
Like who?
Like pension funds, who strictly use PE-based valuation frameworks and literally aren't allowed to buy unprofitable companies.
Oh, wow.
Right now, APPS is a volatile momentum and growth play. If they prove they are sustainably profitable, it matures into a much more stable, defensible investment.
That makes total sense.
Mm-hmm.
So pulling all these threads together for our final verdict, based on the data, Digital Turbine earns an overall bullish score of 7.
Yep.
It is an undeniably fascinating, high-stakes turnaround story. The bull case is incredibly compelling, right? You have an accelerating AI-driven revenue engine, a massive 56% surge in their programmatic ad segment, and confident management raising their full-year guidance.
It's a great story. However, our long-term view remains that this is an extremely high-risk play. That beta of 3.0 guarantees extreme price volatility. The trailing GAAP earnings are still underwater. The core balance sheet relies heavily on those concentrated, vulnerable OEM partnerships.
The toll booths.
Right. And, the insiders are quietly distributing shares into the rally rather than buying more.
Exactly. This is a stock that requires highly disciplined, active monitoring. It is not passive optimism. It's not a set-it-and-forget-it stock.
No. A single earnings miss in that upcoming Q2 report could trigger a brutal, violent reversal simply because so much of the turnaround narrative is already aggressively priced into this 158% multi-week run.
So it's suitable for investors with an elevated risk tolerance, who understand the mechanics of the mobile ad industry, and who are willing to just watch the quarterly data like a hawk.
Precisely.
Well, before we wrap up today, just a quick reminder, if you find our talks useful, please consider subscribe, like, and comment underneath.
And definitely check out that special 14-day trial link for StockOracle down in the description below.
Right, because StockOracle is a fantastic AI-aided stock research platform. Again, it is an affiliate link, so the channel may earn a commission at no extra cost to you.
And just as a final reminder, it's not financial advice or a trading signal service, and AI insights can sometimes be incomplete or wrong, so always verify the facts yourself.
Absolutely. Now, which leaves us with one final provocative thought for you to mull over. We've spent this entire time talking about AI driving this incredible 56% surge in their app growth platform.
Yeah.
But let's take a step back and look at the broader battlefield. We are looking at a highly competitive, ruthless mobile advertising ecosystem where absolutely every major player from Google to Meta to Amazon is rapidly adopting and deploying advanced AI.
Oh, yeah. It is a global AI arms race, and the biggest players have virtually unlimited capital to spend on it.
Precisely. So you have to ask yourself, is Digital Turbine's current AI advantage a lasting structural moat, or is it just a temporary head start?
This is the billion-dollar question.
Will the giants with infinitely deeper pockets simply copy, refine, and commoditize Digital Turbine's AI tools in a few short quarters?
Right. It forces you to deeply question the longevity of the momentum. Is the technology truly defensible, or is it just novel?
Exactly. And if this advantage is just temporary, is a 158% stock run already pricing in a final victory that hasn't actually been won yet.
It's like that hospital monitor we talked about at the very beginning.
Right.
The heartbeat has violently spiked back to life. But the real test isn't the initial jolt of electricity.
No.
The real test is whether the patient can actually get up and walk out of the hospital on their own 2 feet when the adrenaline finally fades.
Such a great point. Thanks for tuning in to Smart Wealth with Joshua. Keep questioning the consensus, keep digging into the mechanics, and we'll see you next time.